Welcome to the Buy Side Brief, the podcast that digs into the strategies, challenges, and successes of tried and tested equity investors, whilst unraveling ideas, trends, and projections on the outlook of stocks and industries. Welcome, Alyx. How are you? Welcome to the Buy Side Brief.
Thanks, Lewis.
No problem. So as a brief introduction for those that don't know Alyx, he's current CIO at Kernow Asset Management, been set up and running the firm or hedge fund for the past 6 years, and is UK long short with a contrarian angle to that. So today's conversation very much so getting into the philosophy, a bit about the journey. I think always good to start off from where it began or rewind to understand where we are today. So you graduated from Reading University, accounting and finance. Was it clear what you wanted to do post university, or because I saw that you, I think you owned an art studio after university, right?
So I've known what I've always wanted to do since I was 15. I've always wanted to do this for a living. You've just got to do the professional side before just jumping into it. Although I did open my own portfolio straight away. So I knew where to go after university, but frankly, I couldn't actually get the perfect job inside the likes of Fidelity grad schemes and investment banks. So I ended up being a consultant to investment banks and hedge funds, which was great because I got to see inside good and bad businesses. And so it was a very lucky and very interesting experience. And that was also 06, 07, 08, which was an interesting time. And I managed to keep my job. I was inside Bear Stearns when it literally blew up.
No way. Okay.
And the art gallery thing, just to touch on that, when I qualified as an accountant, I all of a sudden had my evenings and weekends free, and I wanted to make myself more attractive to women, so I opened an art gallery.
And was that successful? Was that worthwhile?
Yeah.
Can tell by the expression.
Much better, a much better story. I was off the King's Road and in the gasworks, but they've closed it all down now, sadly. It taught me a lot about running an actual business because it's cash, it's unregulated, treat customers well, get the stock in.
Back in the day, when I was 14, I was probably playing football or sports. Where does the passion for equity investing stem from?
It's just another form of game. The sadder side of this is my granddad passed away and I got left some money. It was not a huge amount of money, and I wanted to spend it on the Argos catalogue and buy an Action Man and probably a new mountain bike. And weirdly, I get access to it tomorrow, but I wasn't allowed to touch the money.
So you've grown that for many years, and I expect, given the fact that you set up your own fund, that was pretty successful as well. So you've built that up. Was that strictly UK equities, like you're doing now, or did you
the first 10 years, I did everything I could get my hands on.
Sure.
So if I could invest £1,000, I would. And it was the best learning and a very painful but learning experience. So, but I learned very quickly what worked, didn't work, all sorts of things. And then I really realized I had an edge in UK equities because I knew the people, I knew the accounting, basic fundamental research was going out of fashion, and I actually enjoy that. And I had a clear edge over most investors. And the returns were better in that part of the book compared to everything else. So that's why then I came exclusive on UK equities 2012. Which ties in well, actually, to them managing money professionally just for UK equities as well.
I think I heard you say that, you do UK equities because that's what you know, kind of sticking to the knitting. Given the fact you're at Downing, for the most part, in long only, what was the motivation or reason for doing long short and getting involved in the shorting side, given that you haven't necessarily had too much exposure there when you set up Kernow?
It makes loads of money, and I've been doing it. This is all I've ever pretty much done. If you're going to go into war with a sword, you should take a shield with you because you will die otherwise. And this is a longevity game, and it's the conviction bets that we take. You have to take something on the other side so that you have your exit route, and then your opinion doesn't matter. It's just about making money.
So what you're saying there is that some of the shorts are actually to hedge some of those high conviction long bets rather than actually being standalone shorts?
They're there only to make money. We don't do hedging shorts just for sake of it. But
okay.
You want your sword to be bigger than your shield, but you still need the shield because you're still going to get whacked at. So if that makes any sense. So
sure.
With the it the short book's fascinating. Most people don't do it. It's a very good intellectual challenge. You can see a lot of what's going on in the world very quickly. The action's in the short book in terms of market dynamics and stories. A long book is very slow, and then it's not.
Okay, and in terms of setting up your own firm, it sounds like it was always something you wanted to do, given obviously starting investing from a very early age.
Yeah, yeah.
You obviously probably worked your way up to a nice position at Downing. I assume you'd have had a nice salary, a nice bonus. What was the tipping point for you to go, actually, right, let's finish up here and set up? Was there kind of a catalyst that led you to do that?
Yeah, the opportunity was just phenomenal. You had you had the turnover of a previous bull market. You had amazing companies, amazing valuations. The competition was starting to roll over and people retiring. New fund management businesses were pretty much almost impossible to set up. When I looked for a new home to take advantage of what was going on, it was actually quite hard. Either in someone's shadow or you go to a multi-strat whose long-term horizon is a week. So what I realized was the inefficiency gap is going to get very big, and we can be a franchise and own that gap and be price discovery in the UK. And, you've seen Threadneedle close their UK team and merge it. You've seen Standard Life. You see Buxton retire. It's played out almost perfectly in terms of that view. And the UK looks like is finally pulling its socks up with the buybacks and might even beat the USA this year.
And so what you're saying there is there are a lot of UK funds shutting down. Is that due to the nature of them being more benchmark aware and being long only, or what would be the main reason behind the consolidation?
The industry has moved to where the business people now run most of these businesses, not the investors. And business people want an easy life and are all going to index hug. The whole industry is moving to a cost-based index hug model.
Mm.
And then there will be a few specialists that basically dictate price discovery, and anyone in the middle is going to get squeezed and die and consolidate over time. That's where the industry is today.
So the idea is you're either benchmark hugging, you're thinking you're benchmark aware on the long only side. You've obviously got the market neutral side that you say are way too well for your preference. They're quite very short term focused, and then you're somewhere in between. So if you were to introduce Kernow in terms of philosophy on the long and the short side, how would you do so?
So we're contrarian investment manager, specialised exclusively in the UK. And no one else does it the way we do it. And the tools, some of which we share, are totally unique. And we're at the forefront of basically the investment universe. We have a sandpit of something. We know what works and doesn't work. And we'll continue to invest in that franchise at a greater rate than anyone else. You've got to remember the whole research industry has collapsed on the sell side as well, pretty much. And with ChatGPT, biodiversity of opinion is going to disappear even more. So it's going to be a really, really interesting few years. And we're in one of the few people who can basically take advantage of that.
Hmm. So if you think about some really interesting points there, by the way, but if you think about portfolio composition, I had a look at some of your holdings yesterday evening, and I saw that you've got, a very highly concentrated portfolio. So when you think about longs and shorts, how many do you tend to have on average at any one point in time?
We have 20 longs and 20 shorts, and the top 10 today are 80. It moves around. The key thing here is, the longs are the oak trees that make the money, and the shorts the weeds that I'm taking out every day. So it means I'm in the garden paying attention. If you look at the correlation between stocks over the last 15 years, it's gone from basically 15%, we're up to about almost 40% now, cross correlation between stocks. To fix that, to stop you you need to increase concentration just to get back to where you were. So a 40 stock long only portfolio 10 years ago, and I'm exaggerating for effect, the same output would be a 20 stock portfolio today.
Interesting. When you look at the longs and the shorts, and I'd assume there's a slightly shorter holding period time on the shorts. When you're looking at the long opportunities, are you typically forecasting out 1 to 3 years, or because I read something recently that your investment horizon is shrinking to a certain degree?
Yeah, I mean, so TCI have 10 holdings, private equity, all roughly, they like the best funds tend to have 10 or 12 holdings. There's a reason why most are assets in the top 10. And those investment horizons are on average, our average trade is 3 years, which means if it goes well, it's a 6-year hold period, which is a decent enough time for a tenure and a strategy to work through and all the cash flows and re-rating. Like I said, we've probably traded more than I would expect, but equally we've had interest rates, COVID, Russia. There's been quite a few regime changes, which we do well out of. And that's my excuse for trading slightly more than I would have expected. But again, if you look at our record, we'd have made more money if we'd have traded harder. I expect that to flip the other way. But we don't predict the market. We just take the opportunities we're given and we trade them. It's kind of that, last year it was all about investment trusts. Investment trusts don't work anymore this year. This year was all about commodities and gold and silver. And I can guarantee it won't be gold and silver next year. It'll be something else, but I don't know what it will be.
Sure. Yeah, I understand. Obviously, defence and banks have done particularly well, but I suppose that's wider Europe as well.
So defence are now finished. So defence now are on the short side. Defence is done. It's peak war unless Russia and unless China and America. So the regime in spend from governments is done. It's all priced too highly now. But the quality of the businesses make it quite hard on the short side.
When learning about your investment process, that I think even before this conversation, you mentioned that you have strong relationships with some of the longs you have in the book when it comes to C-level executives and management. On my former episode, actually, I was speaking about how there are sometimes pitfalls to having strong relationships with management or being impressed by how good a human being they are or how well put together they are, and how that translates into actually execution and results. So how do you mitigate against the fact of, being sold the positive picture or assuming great people are going to perform well?
So the first part is, it is important. It's the most enjoyable part of our business to get close to management teams. It's one of those unreplicatable skills that someone on a computer can't do. We're very much the early part of our genesis as a business, and we try and give back. We try and share as much knowledge and insight with the portfolio holdings as well. And that builds a relationship over time. In terms of being charmed, which is essentially the question, is you can't get away from it. Sometimes you will, sometimes you won't. You can try and claim to be dispassionate. The important thing is we have a catalyst tracker. We record the milestones. We record what we do and don't expect. And look, we are reasonably ruthless. We've been short some things and then long. We've gone long and short some things. We don't do our shorts public or do any activism. At the end of the day, our reputation is there as a supportive observer. We're not there for change. So we know our place, and we're pretty clear, I think about that. The ones that are really difficult that I haven't cracked is meeting the short management teams when they know we're short one-on-one.
So there's an element of friction there.
Well, these are criminals. Let's not beat about the bush. These are career professional criminals. And so you're having this conversation and they lie to you. What do you do? Do you put a face on it and record it? Do you challenge it? Where do you go? How do you have that meeting? And so what we've done is take a step back, and essentially we've found an intermediary to do those conversations for us, but they're not as high quality as you can imagine. And background checks and, quasi-private investigators and all the rest of it. I mean, there's a lot online now as well, so you can see all the conferences and all the communications and questions you can get through to other people. At the end of the day, we find really good people and back them and trust them, and we find really bad people and we put them on the we will not invest, and if they do something chronically bad, then we'll short it. So it's kind of it's a pretty easy process. It's a bit time consuming, but it stops you from making disastrous decisions. And hopefully makes the market a better place for everybody else as well.
I know it's a very general term saying bad people, but could there be a situation where bad people perform well?
Yeah. I mean, I'm not going to list names for obvious reasons, but some of the best salesmen and best companies have come out of, let's call it fraud, because the fraud starts small. They raise enough money, then they buy real businesses. The story is so powerful that you get a high rating, and then you can buy your way into stardom. There are some very successful listed and now taken over businesses, and that is very, very true. Ultimately, if you got a black box and it makes infinite money, who doesn't like that?
Yeah.
And we're all smart enough to think we can get out before everybody else. And there's a long history. This is capitalism, right? This is just how the game's played. And there's always a section of society that does that. And we just never want to be invested on the long side in that. That's kind of that's why my granddad was a victim of fraud, and maybe that's why I'm a bit the way I am. And if I'm going to give someone 10 million quid, on the long side, I need to really trust them. I'm not going to understand their business. I'm not going to have the same views as them, but there's a point at which you need to just let go and trust, and let them do their thing. And things happen that they're not in control of, just like myself. And so it's a real, it's just a comfort thing.
Sure. Okay.
And majority of people know what they're doing, are motivated, and just need to be left alone.
Okay. You actually mentioned that some companies you've been short, then you've gone long. I think one of the examples there was Saga, actually, because I think coming into the financial crisis, you had the fact that I think they bought a few cruise ships, right? When there was obviously demand locked up, so a pretty sticky situation to be in. And I think you mentioned that it's a family-run business, which I think many of your holdings tend to be. And they injected some money in the business. I think changed the circumstances as well. So for those that weren't at the Song conference, I know I've probably given a bit of information there already, but if you don't mind going through that, why you were short when you changed to a long, and then the potential upside.
A cruise operator insurance plus 50 market. In COVID, or at the beginning of COVID, in essence, they had two cruise ships turning up that meant their balance sheet was basically bust. They were bust. So we were shorting the balance sheet, not the company or the management team. And the family who had sold it in 2004 came back and saved the business. And the day they sold the business, we covered our short and we brought a little bit on the long side that we made so much money. We thought, well, let's leave the profits in and roll this into the long side. Fast forward to today, the new management team have fixed the business. They've taken over, they've sold off the insurance underwriter, which means a volatile, low return on equity business is now a high return on equity, more stable business, which is an investor's dream. The debt has now got to a point where it's going to be 4 times leverage, so it's almost acceptable. And the liquidity is out to 2031. So that means actually this could be a net cash business if things go perfect. They won't, because it's life. And actually the franchise and people are fantastic. We're really, really lucky for the quality that's there. This has a 10-bagger potential written all over it. It's not like a hard asset with no enduring franchise. And just to top it off, the tailwind is terrific as well, because the quantum of wealth held within the plus 50 market is getting more and more powerful. So 60% of all consumer spending is going to be, by 2030, in the plus 50 market, who I call the silver pound. It's just a phenomenal tailwind. So they should be able to keep margins and have decent pricing power.
Mm-hmm. When you identify a trend like that, with the silver pound, do you then go, okay, Saga's great. Are there any other opportunities where, we could find, dislocation or another long opportunity, perhaps? Is that something you've explored or even acted upon?
That's a great question. Yes, and no. What we do is we look for what if we're wrong. So we flip it the other way and say, well, if our base assumption, and that's quite important to the tailwind side, let's just assume something wipes out all the old people, or they change consumer preferences, and all of a sudden they don't like going outside and they like staying at home and they're plugged into the matrix or what. I don't know. Let's take the exact opposite of what and what would that look like for some companies, and whose share prices would get decimated from that situation? Highly leveraged airline or something, for example, because it will go bust.
To where I was thinking about kind of layering up on the long side due to that theme or trend, if you like, actually being a bit more aware and being, okay, if this doesn't actually come into fruition, well, at least we're okay.
Yeah, if you get it right, you have enough big things that they all overlap, and then your underlying idiosyncratic returns, use jargon, is the main driver.
Mm.
And everything cancels itself out. It never works like that, but that's, it's probably shouldn't use this one, but it's like a horse race where the bookie's got his odds, where whichever horse wins, he's made money. If you've got your odds right and how the odds narrow, you should always win. Now, we don't work in that world of 100% certainty. We work in the world of 2% certainty. So it's a different game, but that's what you're trying to do. So if you had an oil stock and an airline, you can buy, they can both be really high, big bets for you, right? If you've only got one of them, you've taken an accidentally huge price oil bet that you may or may not want. Now, what edge do I have in oil price going up or down? I don't know. So it's just about, once you find something special, how do you protect it and disprove it? And if you can't, you feel comfortable pushing it harder.
Okay. And thinking about, the ideas such as the saga you've just pointed to, when you identify a potential opportunity, what is the threshold for you to actually go, let's do some work on this? I.e., because I've heard before you say, we're invested in a stock. Sometimes if there's been an M&A on it and you get a price rise in the stock as a result of that being bought at a premium, you're not necessarily excited by that 30% uptick in the short term, right? You're looking for 3, 4, as you said with Saga, like a 10 bagger. So to warrant you spending time, and what are you looking for?
So there are 1,500 stocks we can buy, right? We have a map, and it's a really good question, that tells us where to focus our time. So where are the largest mispricings? And I don't think this is the hard part of the business, but we have our own valuation technique, which we're not going to have time to go in here, but we're very, very good at valuing businesses. We can then compare it to the share price, and we just look for the biggest dislocations. And you do an investigation, and I'll pick something real, like utilities are clearly the wrong price. You do an investigation and you realize actually they're not a monopoly, they're beholden to the government, so they don't actually have pricing power at all. So they've gone from being underpriced to actually, given the debt and the weakness of the government, to pretty much being bankrupt entities. You can own the debt, but I would never touch the equity. So that investigation leads you to, these things have to hit you between the eyes and be really, really obvious. And most things don't need to a trade, or they're too noisy or loudly. And then sometimes when something magical happens and it hits you between the eyes, the stock market just hates this stock for some reason, or it's ignoring this really crucial thing for some reason. And that is a trade idea. And then you link that with a catalyst, and all of a sudden you have a project. And we do 2 or 3 a week, and we execute on 3 a year. And
that, when you go into a particular year, have you got an idea of what returns constitutes a good year for you on the absolute side, or do you focus more absolute, or is it more relative return? And
I want to make, if I don't make 15%, then I'm annoyed, because I want to double my money every 5 years pretty much. But again, it comes down to the opportunity set. So this is the best, we're in a bull market now. This is a much easier time to make money. Everyone's making money. It's about how much. Sort of 4 years out of the last 6, most people have been losing money or going sideways. And so it was pretty more on the survival mode. We're in an upgrade cycle in most our small caps. If they kick on, we could do 40%. If small caps never come back and liquidity goes to the large caps, that won't happen, and there'll be a drag. So we have a range of outcomes. But if you're not trying to do 10, 15, 20, then just go buy some bonds. The market historically we've done 2 times the market. I've done 3 times since the beginning of my personal portfolio. And if you can do that, that you're capturing enough of the skill value and evolving enough to build something special.
Sure. And the market for you, it would be FTSE, kind of FTSE all cap, or what's the market that you bench yourself?
So if you were going to give money to Kernow, what's the equivalent if you didn't? Well, you either give it to another asset manager, or you just buy a passive index. So what's the easiest, quickest one? So you FTSE all share. If you want to take a view on market caps, you can. But my thing is, what's the base index rather than doing active and all the rest of it? We should hopefully beat all the other ETFs as well. But
so you're saying there is you've been 2 times the market since you've been running Kernow, relative to
roughly. I think we're a bit the large caps done a bit better this year, but I've done 3 times before. We're trying to do 2 times. That's where it will come out on the relative side. And then on the absolute, we're trying to do 15.
Okay. And on this year's performance, last year's performance, how's that actually shaken out in the more near term?
We're 14 this year. We were 23 last year.
Impressive. Okay. And do you ever split it out in terms of, because I was working with a hedge fund more recently and they have better short alpha than they do on the long side. Is that something you look at? Are we performing better on the longs?
It's a good question. So we actually have better short alpha as well. But just to put things in context, our short book is always often quite small. So it's gone from 40% this year to 30%. Last year, if you looked at our portfolio, you'd want us to push the short. We had 6, basically almost not zeros, but 50, 70% gains in our shorts last year. We had a really, really, really good year in our short book last year. And if you look, and then you would say, well, why don't you leverage up the shorts and do more of them? This year they've been rubbish.
Oh, really?
But it makes sense, like, because those cohorts of IPOs and dross have all gone. I haven't found a fraud this year, I don't think.
And your shorts are purely frauds?
No. I'm exaggerating the point. We do failures, fads, and frauds.
Okay.
But in 2001, and you had a whole cohort. All of a sudden, I would have 20 suspicious individuals turning up as
doesn't rain, it pours.
Whereas now we've had one gambling company in the last month with a person previously who is very, very successful but has an interesting past. So it just goes through cycles. The short book, as I said, will probably do 0 over 10 years, but provide basically protection leverage to the shorts. And our biggest position today is Burberry. That's gone down on us 50% twice, despite us being up 100% on it. That volatility over 18 months has been horrific. You couldn't do that without a short book on the side.
I bumped into you again at the Curation Collective event, which was focused more on AI.
It was interesting. It was fun, wasn't it?
I thought it was really good. Learned a lot there around kind of the value chain and different pockets of where investment ideas can come from. But it seems like we've got a real mismatch in terms of power supply. When you think about AI, I I suppose the event actually spoke to this as well, about how money may flow more towards the US or even to China, away from countries such as the UK, where, Waymo comes in and you have less taxi drivers, for example. So given that you're UK only, have you thought about the fact that you may be, on the long side at least, not be able to exploit some of those opportunities where you've got the structural tailwinds and innovation from AI that, US and Chinese companies may really benefit from?
Yeah, it's a great question. So if we do some bottom-up analysis and there's a winner or loser that fits that thesis, then we trade it. It's mostly losers, which probably speaks to the way our question's coming from, that we found today. One that we've closed, so I can talk about it, is RWS, a translations company. What you're really talking about is a lack of sovereignty. If you don't have control your energy, power, borders, food, and armies, and you outsource everything, your sovereignty collapses. But that's not necessarily a bad thing as well. If the world's more interconnected, it might mean it's more stable. I don't know. But again, if that story of China and America win it at all costs, and that means large caps will be the dominant winner over the next few years in the UK. So despite our small caps screaming at us for upgrades, it doesn't matter. They're not going to make any money. The flow is going to go to large caps. So you can buy a UK company with, say, US revenues on a huge discount. And you've seen a couple of UK companies moving their listings or secondary listings to America, which is chasing that theme. And so we all trade, again, the opportunity that we're presented with. The UK is still going to be number one for Europe. It's still the largest city, has the best rule of law, the best employment opportunities. You've got great companies like Arm here. They're not listed here, but it's still going to be a part of the puzzle. And then going to things like Burberry, that benefits from China and America. Those are their two largest markets, right? And once they make all the money, they've got to spend it because they need to show their status.
On the topic of AI, when you think about your investment process, your research process, how have you incorporated it in, if at all? And do you foresee that developing over time?
So we were quite chuffed when we set up because we had 10,000 lines of Python code. And I mentioned earlier our map and our model. We had some really interesting stuff we published on the Kernow Journal about how we could analyze text, what that meant, and putting our nuances on what management teams were saying. And that edge has basically been eroded away because now anyone can use ChatGPT and get halfway there to what we've built. And if you look at RNSs, they've all started to use the same language as well. So the extra data you used to get from that's disappeared. What's not disappeared is body language and talking to people, but that's hard work, right? And they can't do that across 200 or 20 announcements a day. Like, you'd be hard pressed to. So no, you couldn't do 20-hour long meetings in a day, could you? Just kidding.
It's a long day.
Yeah. But that's part of the game, right? That's how the market evolves. Ed, my business partner, who's the key to this whole business, who's the CEO, he studied maths and AI at university. So I think we were a modern firm. We're very fundamental, but we're quant aware. I still think we have a decent edge on that. We definitely have an edge on the fund flows that most people have missed. And it's our job to be at that forefront, as I said earlier, of investing in finance and finding out where the market's going or what inefficiencies are being eaten or not eaten.
Okay. If I was an investor now, an allocator, a pension fund, I had 10 million to invest, why would I invest in Kernow rather than another UK long-short directional fund? What is it that you do differently that perhaps you haven't mentioned so far?
Well, we're completely differentiated. There's very low correlation, and we have the best track record. So, but really, they'll come to us if the story fits, and they like the UK but want a slightly different bent on it. So a lot of people already have either an index or another position, and we kind of sit there as a wild card. Ultimately, we'll give you an alternative view. We're contrarian. We're at the boundaries of what's going on, and we're very helpful. I think that is very helpful in testing thesis, and clearly adds value to the portfolio and positioning.
I think you've said before, if you'd have known setting up Kernow would have been this challenging, you may not have started at all. What have been the main challenges to overcome?
The main challenge is first you've got to find good people to work with is a really obvious one. But Bezos and everyone talks about it, and I got really, really lucky with Ed. He's fantastic, and you can overcome pretty much any challenge. I never really used to speak to investors. I was like more guy in a white coat, locked away, doing DCFs as opposed to, and I naively assumed you just show people how good the cooking is, and then someone gives you a restaurant. That's kind of the leap that, I literally went into a car park and was handing out bowls of soup saying, can I set up a restaurant? It'll be a Michelin star restaurant because this is the best soup in London. Like, that's how naive we were.
Yeah, I've spoken to funds that produce, returns of 30% absolute returns in 1 year, and they haven't raised any capital, and then next year they don't have the best year, and then they're looking at struggling to keep the fund afloat. And it's really interesting hearing that you can perform all you want, but if you don't have the exposure and the commercial side, then you still might not. There's no guarantee, right?
Yeah, again, looking at the food analogy, the food on the high street and the brands and the franchises, majority is pretty rubbish, right? It's not hard to win on the quality side, but to win on a story and find a space, and you can do it in novel ways. So I think we were one of the first people to have an Instagram account as a hedge fund, right? Our LinkedIn we get a lot of weirdly inflows from our LinkedIn account. That costs pretty much nothing to run and gives you a distribution and a voice. And authenticity is valued by a certain select number of people. And so we got lucky with our enthusiasm and our stubbornness. And we found some really, really smart investors who then told us this is what they would like. And we built as we went. So we've got a UK fund, it's UK regulated. We've got a full FCA license, for instance. We went for as much transparency and regulation as we could. We have the institutional accounts, which is where the big money is, and it's all very easy, but they will move and evolve a lot over the time. The institutions of today won't be the institutions of tomorrow. And then our best clients tend to be the family offices who've got a longer term horizon than me, and I've got a 20-year term horizon. And that's very high quality, very interesting entrepreneurial conversations, which you learn a lot from. I probably learn more now from my clients than the books behind me.
Yeah, I speaking to a lot of individuals in the market, usually the more experienced individuals always would like to work at a family office due to the stability of capital and the autonomy and the flexibility to invest in direct equities, but then also to look into solutions that you're offering as well. So obviously coming up towards the end of the year now, how are you thinking about 2026? Have you got any key milestones you want to hit next year, or even over, be it the next 5 years? What's kind of next for Kernow?
I thought about this because I can give a whole story, but I just don't think like that. I
Mm,
think uh, Alex Ferguson said, just win the next football match. And in
mm,
trading, you're only as good as your last trade. So there's no point, yes, I'd like this, and yes, I can paint you a story about where we'd like to be in the table and all the rest of it, but just win your next match. Like,
mm.
that's all that matters. Unless it's part of a trade and everyone's thinking something about 26 and all of a sudden there's a gold boom stock and I can start shorting the gold. If anything, I'll be on the other side if it becomes frenzy. If this was 98, 99 and the IPOs were popping big, so we'll wait for the froth, and it's more the causality is the other way. But we really, really are focused on, we've got our process, we love our process, we're good at it. Every week, how can we make that better, tighter? Where can we spend more money? Who do we need to speak to? Where is this inefficiency? Where are we wrong? Where are we right? Likewise, what are the competitors doing? And, it is the toughest, best game in the world.
Mm. Yeah,
And we've just got to
that's
stay on top of that.
sure. So I gather you're a Manchester United fan then.
No,
If
I
you're
just
taking
I
votes.
like biographies, so I did Alex Ferguson's one last week or so. Lord Credus's one was up there, which we talked about just before. So yeah, I think Charlie Munger said he just did biographies towards the end of his career, and I've run out of books, and I've decided biographies are the way to go at the moment. And a lot of these guys are still alive as well. You can go speak to them.
Yeah,
You can read their book and then go meet them and ask the question, which is another thing that kind of blows my mind a little bit.
yeah. So I suppose there's a final question then. So I know that I deal with whether it's junior analysts to senior PMs in the market, but if you were to look towards the guys that are maybe 2 to 10 years worth of experience, from where you are today, given that you've set up and run your own fund, which is due to the performance and things like that, a success, and I hope that continues. What one key point of advice you give to someone starting out their career?
Yeah, I'm glad you picked someone starting because I don't think I could give advice to the other guys. So, because we're the same. Starting is just, if you know your personality, what you genuinely enjoy, lean towards that. Particularly investing, there's this thing where you want to match your personality to your trading style.
Mm,
And the sooner you get that and the closer you get to it, the better and easier it's all going to be. And if it's not your passion or your edge, your thing, there are easier ways to make a living and make more money, have less stress. So the sooner you can find that intellectual honesty and push it, the better. And if you don't know, leave as many doors open as possible. It's kind of like school advice and all the rest of it.
it's an interesting point actually, because I suppose some people just don't know until they've
Yeah,
tried,
and if
do
you
they?
don't know, and for me, Market Wizards was very, very helpful because I could see there was all these different investment styles, and some I would literally be like, get goosebumps, and I can completely relate to it. And other things I'd be like, I've no idea, that doesn't work for me. By definition, you need different parts of the market. But if you're going to win, you've got to be basically obsessive. And if you're not obsessive, go do something else.
A really good point actually. So kind of follow that.
Yeah. Yeah.
Don't try and
You
be
work on
someone
the
you're
sell
not.
side. The sell side's quite fun because you're always getting the new stories as opposed to pushing the one idea or whatever. So, yeah, Market Wizards, marginal safety, reflexivity, quality investing. Read those four. Pick something and then go for it, or go do private credit or a state agency or whatever. It doesn't really matter. Just if you want quick money.
Yeah, no, that makes sense. You have to ping me the names of those books after actually, because I'd quite like to read a couple of those. But
Don't
Alex,
read reflexivity last because it's quite hard.
really, okay,
Yeah,
ease
yeah.
myself
Read
in.
Market Wizards first.
Okay, Sounds good. But no, Alex, I could speak to you all day. I think you're you're a really charismatic guy, and obviously love what you do. And you're doing really well at it. So yeah, great to have you on the podcast, and look forward to seeing what brings 2026 for you and Kernow. And yeah, been great
Thanks for the
speaking.
questions. I really enjoyed it. That was very good. A lot of fun.
Speak to you soon.